Silver just made a move that's going to be misunderstood by almost everyone watching. And if you hold even a small position in precious metals, what I'm about to explain could be the difference between staying positioned for a massive opportunity and getting shaken out right before the breakout you've been waiting for. In the recent trading sessions, silver didn't just pull back gently or experience a typical red day. It surged with serious momentum and then snapped back with violent whipsaws that made confident holders suddenly question their thesis and cautious observers suddenly feel the urge to chase. This wasn't normal price action. This was silver entering what I call a high volatility momentum phase, where 8 to 10% swings can materialize rapidly and without much warning. The market is starting to behave like it's gearing up for a serious attempt to break through the psychologically critical $100 level, with a hot zone target near $106 sitting above it like a magnet pulling price higher. But here's the critical twist that separates winning traders from those who get destroyed in these environments. The exact same volatility that has the power to launch the next explosive leg higher is also the weapon that systematically wipes out late buyers and over-leveraged traders who don't understand what's actually happening beneath the surface. If you don't understand the real mechanics behind these sudden smashes, shakeouts, and violent reversals, you will get removed from your position right before the move you've been patiently waiting for finally unfolds. What I'm going to do in this breakdown is walk you through the actual forces driving this price action, the key levels that matter most going forward, why many of these recent brutal sell-offs are mechanical rather than fundamental, what gold is quietly signaling in the background that most people are ignoring, why mining stocks are lagging in a way that could actually be bullish for the next phase. And at the very end, I'll give you the one critical rule that prevents you from turning a winning position into a painful round trip that costs you both money and confidence. Before we go further, this is John AG, and I need your direct support for something that matters. I'm actively running a campaign to eliminate copycat channels that steal original analysis, repackage content, and repost it as if it's their own work. If you genuinely value original research and honest perspectives, I need you to subscribe to this channel right now and leave a comment that says OG John AG, so I can recognize and connect with real supporters who care about authenticity. That single comment helps push this message harder and helps clean up the space from low-quality imitators. I've also created a WhatsApp channel because I want to stay directly connected with the real audience. You'll get daily updates, quick market notes, links to new videos as soon as they drop, and sometimes my personal observations about what I'm watching and experiencing in real time. The link is sitting in the description below. Join it so you're not reacting late to major developments when timing actually matters. Now let's get directly into what's happening in the market and why it's unfolding this way. Silver isn't leading the precious metals complex right now, just because it's exciting or because traders are bored. Silver is leading because capital is actively rotating out of stalled asset classes and into sectors that are actually moving with momentum. When equity markets chop sideways for months without clear direction, money starts looking for a new home where it can actually grow. And right now, metals have captured that momentum and that attention. You can see this shift clearly in the way market focus has changed. Silver, copper, resource-related names, and mining stocks are all creeping up the priority list for institutional and retail participants. This isn't happening because the fundamental news got prettier or because some new catalyst appeared. It's happening because the capital flow changed direction. Silver is a particularly special case in this environment because the market is relatively small compared to other asset classes. When large pools of capital begin leaning into a small market with limited liquidity, price doesn't crawl gradually higher. It lunges, it gaps, it moves in ways that feel disproportionate to the news. That's exactly why silver can look boring and range-bound for weeks or even months, and then suddenly it feels like a rocket that you can't catch. But rockets shake violently, and that's something you have to accept if you want to participate. When you see repeated 10% daily moves back and forth, up one day and down the next, it's not random noise. It usually signals that the market is becoming crowded. Big institutional buying is meeting big institutional selling. Positioning is getting heavy on both sides. And when positioning gets heavy, the next directional move tends to be bigger and more violent than most people expect, because one side is going to get forced out. Now, everyone watching silver right now wants the same simple answer. Are we going to $100 or not? Here's how I think about that question in a practical way. $100 is not a magic number from a fundamental perspective, but humans are psychologically wired to respond to round numbers. $99 feels like just another number on a chart. $100 feels like history. It feels like a milestone. It gets headlines. It gets attention. It changes behavior. When a market approaches a major round number during a momentum phase, you generally get one of two narrative paths. The first story is that the market punches clean through the level, triggers a massive wave of mainstream media headlines, and the late crowd floods in with FOMO-driven buying. That surge of new participation can fuel a fast and aggressive extension even higher. The second story is that the market teases the breakout, gets close enough to make people believe it's happening, and then rips violently lower in a brutal shakeout specifically designed to create maximum emotional and financial pain. That shakeout scares existing holders into selling, traps new chasers at the worst possible prices, and resets leverage across the entire complex. Both of those stories are completely possible, and that's exactly why the real skill in this environment is not trying to predict which one will happen. The real skill is preparing yourself mentally, emotionally, and financially for either scenario, so that you can respond intelligently instead of reacting impulsively. Now let's talk about the $106 area that I mentioned at the start, because I'm not telling you that silver will definitely reach that level. What I'm telling you is why that level matters structurally and psychologically. Markets behave like magnets when clear targets become widely recognized. Targets become magnets because institutional traders front-run them. Algorithmic systems react to them, and social media turns them into a public scoreboard that everyone watches obsessively. Even if price never settles at that level or holds there for long, it can spike toward it and then reverse so fast that your brain can't process what happened in real time. So if you're watching silver and imagining a clean, smooth, straight-line ride higher, you need to forget that idea immediately. The ride will be messy, the path will be chaotic. The payoff, if it comes, will come wrapped in volatility and confusion. This is where the biggest and most expensive misunderstanding shows up among retail participants. Every single time silver dumps hard intraday or overnight, people immediately scream manipulation. They assume that evil forces are deliberately suppressing the price to protect short positions or serve hidden agendas. And yes, sometimes markets are unfair, and sometimes there are structural distortions. But a much cleaner and more accurate explanation for many of these sharp, sudden pullbacks is mechanical margin pressure. When volatility rises across the futures complex, exchanges and brokerage firms often increase margin requirements to protect themselves from systemic risk. That means anyone using leverage to hold positions suddenly needs to post more cash collateral immediately to keep those positions open. If they don't have that cash readily available, they are forced to sell. Not because they changed their fundamental view or lost confidence in their thesis, but because the system mechanically demanded more collateral, and they couldn't meet that demand. Here's the part that most retail traders completely miss and don't understand. The people who are leveraged long in silver are very often leveraged across the entire precious metals and commodities complex. If you're long silver futures, there's a high probability you're also long gold, platinum, palladium, copper, and mining stocks. So when margin requirements rise suddenly, that forced selling pressure doesn't stay isolated in silver. It spreads across the entire basket of related assets. That's exactly why you see these ugly, violent red candles that feel like a coordinated attack, followed by sharp recoveries that make it seem like nothing even happened. The move wasn't driven by a new bearish narrative or a fundamental change. It was driven by plumbing, by the mechanics of the financial system forcing position reduction. This dynamic is also precisely why being directionally correct about where silver is heading isn't enough to make money. If your position size is too large or if you're using too much leverage, a mechanical forced liquidation event can remove you from the trade entirely before the underlying trend resumes. You can be right about the destination and still lose money because you didn't survive the journey. Now, while silver is stealing all the attention and dominating the headlines, gold is doing something extremely important in the background that deserves your attention. Gold has been moving more like a steady staircase than a dramatic firework. It rallies, pauses to consolidate, rallies again, pauses again. That rhythm and structure matter significantly because sustained long-term bull markets in any asset class almost always advance in waves rather than straight lines. You don't get a vertical move that never pulls back. You get distinct legs separated by consolidation phases. Many experienced traders are watching a zone roughly around $5,100 to $5,200 as the next major area of potential resistance or reaction in gold. I'm not saying that's a prophecy or a guaranteed target. I'm saying it's an area, a place where price might encounter selling pressure or profit taking and react in a meaningful way. What I want you to notice and focus on is the structure of gold's advance. It's making higher highs and higher lows. Moving averages are sloping upward. Pullbacks look like they're driven by short-term news events rather than breaking the underlying trend structure. And here's the mindset shift that changes everything about how you perceive value in this environment. Gold isn't getting more expensive in any absolute sense. What's actually happening is that the currency you're measuring it with is getting weaker. Gold is the measuring stick. The stick itself didn't change. The units you're using to measure with it did. When it takes more dollars to buy the same 1 ounce of gold, that's fundamentally a story about purchasing power erosion. That's exactly why people who treat precious metals as long-term wealth insurance and protection don't obsess over finding the perfect entry price to the nearest dollar. They obsess over staying financially solvent and staying positioned so they don't miss the major moves. But in the short term, yes, you absolutely still need to respect dips. You still need to respect volatility. You still need to avoid emotional chasing of breakouts. Now let's talk about mining stocks, because this is where a lot of people get confused and frustrated and make poor decisions. Before we go deeper into miners, let me directly answer the 2 most common questions and messages I've been getting repeatedly this week. The first one is this: if silver is so strong and the trend is so bullish, why does it feel like the market is trying to throw me off my position every single day? The answer is simple. The market's job is not to make you comfortable or to validate your thesis. The market's job is to move price to a level where it can find the next willing buyer or seller to facilitate the next transaction. And in fast-moving parabolic phases, it finds those participants by creating fear, then brief relief, then fear again. It's emotional conditioning designed to test your conviction and separate weak hands from strong hands. The second common message is this: should I be holding physical metal, or should I be using paper exposure like ETFs, futures, or options? Here's my straightforward take. Physical metal is for people who want direct ownership without relying on someone else's promise or counterparty obligation. It's slower to buy and sell. It's calmer psychologically because you're not watching minute-by-minute price swings affect your account balance. And it's not designed for rapid flipping or trading. Paper exposure through financial instruments is for people who want liquidity, quick execution, and the ability to enter and exit positions rapidly. But it comes with rules, margin requirements that can change overnight, and counterparty layers that can become critically important at exactly the worst possible time during a crisis. So whichever path you choose, make sure it matches your actual personality and risk tolerance. If you can't sleep at night when price moves against you, don't use leverage. If you can't control your impulses and you're prone to emotional decisions, don't chase breakouts. If your goal is to build long-term financial protection and preserve wealth, think in terms of years and decades, not in terms of what happens next Tuesday. Now let me add one more piece of critical context that almost nobody talks about during parabolic price runs. A lot of retail traders treat increasing volatility as a signal to add more position size, because they mistakenly think that big moves automatically equal big opportunity for them personally. And sometimes that's true if you're positioned correctly and managing risk well. But big moves also mean that your risk expands dramatically. Your stop loss has to widen to avoid getting randomly stopped out. Your dollar-denominated swings get much larger, and suddenly what looked like a small, reasonable position starts to control your mood, your sleep, and your decision-making. So if you want to survive what's coming in the next phase of this move, you need to size down before you even think about sizing up. You earn the right to add to winning positions through disciplined risk management. You don't demand it just because you feel bullish. Keep this reality in mind as well. When silver finally hits mainstream financial media headlines again in a big way, you're going to see non-stop stories and commentary about how it's overheated, how it's time to take profits and lock in gains, and how the top is definitely in and you should get out immediately. Just like every other cycle in history, the loudest and most fear-driven voices will show up at the most emotionally extreme moments. That's exactly why I want you focused on underlying structure instead of surface-level noise. Ask yourself these questions regularly. Is the market still making higher lows? Are pullbacks being bought aggressively by new buyers? Are the sell-offs happening on margin-related events and then recovering quickly? Those are the real tells that reveal whether the trend is still intact. Now back to mining stocks, because this is a source of constant confusion. If metals are ripping higher with serious momentum, why aren't mining stocks flying at the same pace or even faster? The answer is that miners are operating businesses, not bars of metal sitting in a vault. Mining companies have complex cost structures including labor, energy, equipment, and regulatory expenses. They face political risk in the jurisdictions where they operate. They face operational risk from accidents, strikes, or production issues. They face energy price risk. They face management execution risk. And critically, miners trade inside the broader equity ecosystem. Physical metal can act as a global safety valve and store of value during crisis moments. Mining stocks can still get sold aggressively, like any other equity during risk-off market environments, when investors are dumping everything. So, underperformance by miners relative to the metals themselves doesn't automatically mean that the metal move is fake or unsustainable. Sometimes it simply means that large institutional money prefers the clean, direct exposure first, which is the metal itself. And sometimes it means the market is worried about profit margins. Rising energy costs matter enormously to miners. Input costs matter. A rising oil price environment can pressure mining company margins even as the metals they produce are rising in price. That's why miners don't behave like automatic pure leverage to metal prices. Sometimes they amplify the move beautifully, sometimes they disappoint and lag badly. If you look at mining stock charts during volatile periods, you'll often see a technical pattern that is specifically designed to break your confidence and force you out of positions. A very common one is called an ABC correction structure. There's a first drop that scares some people, then a bounce that gives false hope, then a final flush lower that slightly undercuts the prior low and triggers stop losses. That final flush is the shakeout. It triggers all the stops that were placed just below obvious support. It convinces the majority of participants that the move is completely over. And then it turns sharply and runs higher, leaving those people behind. That's exactly why using tight stop losses in a volatile bull market environment can actually be a liability instead of protection. You think you're being prudent and safe, but you're placing your exit order exactly where the market systematically hunts for liquidity. So what should you actually do in this environment? You keep your process simple and disciplined. You don't try to become a fortune teller or a prophet. You become a risk manager and a probability thinker. You ask yourself these questions consistently. Is the underlying trend still intact? Is the market structure still holding key support levels? Are the pullbacks mechanical and quickly reversed? Are capital flows still rotating into this sector? Are buyers stepping in aggressively on moments of weakness? Those questions give you much better information than trying to predict exact tops and bottoms. Now, I want to bring this back to silver specifically because this is the absolute core of what matters right now. Silver is currently in the zone where a single strong coordinated push can carry it clean through the $100 psychological level and ignite widespread public participation and media attention. If that happens, the next upside magnet sitting above current prices can pull price higher faster than fundamental logic would suggest. But if that initial push fails or gets rejected, the market can still deliver a savage, violent dump first to shake out weak hands and reset positioning, and then make the real sustained move higher after it has humiliated everyone and forced them out. This is exactly why the next phase is not simply about being bullish or bearish. It's about being prepared mentally and financially for extreme whipsaw volatility. Here are the two biggest ways that retail participants lose serious money, even in the best and strongest bull markets. First, they chase the breakout with pure emotion, size up their position far too much, and then get violently shaken out on the very first sharp pullback. Second, they hold a genuinely good position. They see a large unrealized profit build up. They get greedy and refuse to plan any kind of exit or profit-taking strategy, and then they watch those gains completely evaporate because parabolic moves reverse just as violently as they advanced. So the goal here is not to guess the exact peak or to catch the perfect top tick. The goal is to build a plan and a mental framework that survives both possible outcomes. If silver spikes dramatically higher, you already know in advance what you're going to do. If silver dumps hard, you already know in advance how you'll respond. You don't make those critical decisions in the heat of the moment, because the moment is specifically designed by market structure to trick you into making the wrong choice. Now, I want you to do two things for me in the comments section, because your input directly helps me shape what I cover in upcoming videos. First question, do you think silver touches $100 cleanly on the first attempt? Or do you think it fakes everyone out with a brutal shakeout first before making the real move? Second question, are you personally stacking physical metal? Or are you trading paper exposure through vehicles like ETFs, options, or futures contracts? Drop your honest answers below. And one more thing. If you've experienced success in any area, whether that's business, investing, career growth, a side hustle, or anything else that genuinely changed your life and financial situation, share a quick 1 or 2 sentence story in the comments. Real examples from real people raise confidence and provide motivation for others who are still building. The reason this current moment feels surreal and almost unbelievable to many participants is because silver is a tiny market relative to the total scale of global capital flows. When even a small fraction of global institutional or sovereign demand turns towards silver, there simply isn't much room to absorb that flow without major price adjustments. The price has to adjust fast and dramatically, and that speed of movement changes human behavior in predictable ways. People start checking price charts obsessively throughout the day. They start refreshing their brokerage accounts every few minutes. They start doom-scrolling social media and financial news looking for confirmation or warnings. Some people start bragging about their positions publicly. Others start panicking about every small dip. And that's the exact point where you stop trading the actual asset and start trading your own nervous system and emotional state. So here's the critical rule I promised at the very beginning. In parabolic momentum phases, you do not get paid for having certainty or for being right about every single tick. You get paid for having a disciplined process that you can actually follow under pressure. Process means using position sizing that you can comfortably hold through violent swings without panic. It means choosing exposure levels that actually fit your life, your sleep quality, and your emotional stability. It means having a plan for how you'll handle volatility before it arrives. And it means having the wisdom and patience to let the market prove the next step instead of trying to force it. If you're not in a position yet and you're feeling intense FOMO, do not chase price emotionally. Markets almost always offer reasonable entry opportunities through dips, consolidations, and shakeouts if you're patient and disciplined. Patience is your admission ticket. If you are already in a position, don't let short-term volatility bully you into making impulsive decisions that you'll regret. Respect the swings, acknowledge the uncertainty, but don't surrender your carefully thought-out plan. Here's something specific to watch closely over the next several trading sessions. If you see silver dip hard intraday or overnight, and then snap back quickly and erase most or all of those losses, that's a very strong sign that serious demand is waiting under the market ready to buy weakness. But if you see silver rally toward a key resistance level and then stall there for multiple days right under that level without breaking through, that's often the market loading the spring and building energy for the next explosive move. Both of those technical setups can lead to a major breakout, but the path and the price action will look different. So don't just stare passively at the price number. Watch the reaction and the behavior. Watch how quickly buyers respond to sell-offs. Watch whether those sell-offs get completely erased or whether the weakness lingers and builds. That reaction speed and character is often the real signal that tells you what's coming next. And remember, if you want me to cover specific silver trade setups, mining stock analysis, or even practical risk management examples using real positions, tell me in the comments what you're currently holding and what time frame you care about most. I'll pick several comments, break down those situations in detail, and turn them into the next focused video. Now we're getting close to the end, and this is where I need to be completely blunt and direct. My channel statistics show a frustrating reality. A large number of people watch these videos, benefit from the information and analysis, and then still don't subscribe. If this content genuinely helps you make better decisions, I need you to support the work. Subscribe right now. It's literally one single click. And if you want to actively support the campaign against copycat channels that steal content, leave a comment that says OG John AG so I can see you and recognize you as part of the real community. That comment is your badge. Also, don't forget about the WhatsApp channel. The link is in the description. Join it because daily updates and real-time context keep you ahead of the emotional reactive crowd and help you make calmer, better decisions. Here's the final cliffhanger. If silver truly is entering that euphoric parabolic zone, the biggest and most important updates may arrive clustered together in rapid succession, fast, chaotic, and impossible to time perfectly. And the people who win in that environment won't be the loudest or the most confident. They'll be the calmest, because they'll already understand that volatility isn't a sign of panic or danger. Volatility is simply the price of admission to extraordinary opportunities.